Welcome to Bryson. My name's Conrad. I'm a business strategist, and I'm going to share what the difference is and if you should pick either an LLC or a corporation. I will share exactly what my opinion is. I am not your attorney. I am not your tax professional. Do not sue or litigate me. Bryson is not giving advice. We're just sharing something that we've learned along the lines of doing business and having a consulting firm that might be able to help you. You'll always want to do your own due diligence because within different states, different countries, different continents, there's different rules and regulations. So you always want to check with your local authorities, your local tax professionals, your local insurance agents, etc., to make a more sound decision. So let's dive right into it. LLC, limited liability company or corporation. There's C Corps, which are corporations, which give you the ability to have a limited amount of shareholders. There's LLCs that also allow you to have an unlimited amount of members, but very different, and there's different tax implications. Again, I'm not your tax person. I'm just sharing my experiences from our clients here at Bryson's. We are a consulting firm, and I'm a business strategist. So again, there's different ways you can set up your business. You can set it up typically sole proprietorship, and as a sole proprietorship, you're not afforded the liability protections if you would be sued as a business. So for example, if I'm Conrad, X, Y, and Z, right? LLC. Typically, I will have liability protections to protect me if I am sued as Conrad X, Y, and Z LLC. But be very clear and speak with your attorney. If you're a single member LLC, unfortunately, the IRS at this time and for numerous amount of years see this as a disregarded entity. What that means, you say? It's the same way how the IRS reviews and looks at a sole proprietorship. The difference, though, is a sole proprietorship does not have limited liability protections. It's you as the person, Conrad the person, and you sue Conrad as the person who's doing business, either with doing business as or just as a sole proprietor with my first and last name. So you have no liability protections. The cool thing about LLCs is if you're a single member LLC, you still get those liability protections. So that's a big win, but you still are seen as a single member LLC. And the reason that's in regards to taxes and how IRS code sees you, they might even see you as a hobby business, meaning that when they don't really take you seriously. They feel you're just someone who's figuring it out, maybe trying to become a business. They don't see you as a business, even though you have an actual EIN, even though you have an actual LLC. If you're the only person running there, first, it's not very hard for them to audit you. That's typically all your pass-through income. This when you have an LLC, it gets passed through to the owner's income on their actual tax documents when they're filing taxes. And this makes it easy for the government to audit you, simply put. So to avoid this, you can actually open up with another person, maybe have a proper operating agreement in place. That shares what the rules are between you and this partner. As soon as you have more than one person in your LLC, now it's a multi-managed LLC, and now it's treated as an actual entity. But again, maybe you don't want to team up with someone. Maybe you don't need to team up with someone. That's fine. You just want to make sure you do a good job of documenting what business expenses are, do a good job of documenting what personal expenses are, and keeping everything as separate as possible. There's something called piercing the corporate veil. When you have a limited liability company or corporation or an S Corp, you can actually get liability protections that allow you to protect you so that you have this umbrella of liability protection that protects you. So if someone sues you, someone slips and falls maybe at a property that you're renting out, maybe you own a property, maybe you're renting cars, maybe you own some type of business, someone gets hurt and they want to sue you, they can't sue you for your personal assets. They can't attack your child's 529 accounts for college. They can't attack your Roths, your IRAs. It really protects you in those situations. But if they find out that you're commingling funds, expenses, paying for business expenses with personal credit cards, and not properly documenting that these are business expenses, unfortunately, you could lose liability protections. So that's essentially the difference between these and what they kind of offer. But again, I'm not giving any type of legal advice. This is sharing my experiences, my perspectives, and from the stories of our clients that we've helped here at Pearson Bryson. But you want to really and thoroughly understand this. So another thing, if you want to become an S Corp, the cool thing about this is this. If you are an LLC, the cool thing about this and what makes this S Corp different from the C Corp, the C Corp, typically you have to pay 2 times your tax, you're double taxed, which makes perfect sense. There's a reason for this. And typically this gives you a limited amount of shareholders. So if maybe you're someone who has a startup that you want to receive some type of angel investor income, or you want to be open to investments, this is typically what you'll have to actually form is the actual C Corp, so you're not limited. When you have an S Corp and you elect by filing IRS Form 2553, you can actually only have the max, you're capped at 100 shareholders. So 100 shareholders, that doesn't give you the best opportunities if you're trying to go public. And remember, when you go public through the United States Securities Exchange Commission, you have to actually go, when you go public, when you're, say, traded like Tesla or traded like McDonald's, when you trade on the public to gain more capital and you become more prominent, you actually need to be a C Corp. Because again, when people are investing into this company, like first, the shareholders want to be protected. And at the same time, you want to be able to accept as much money as you possibly can. And you have more control. An S Corp only gives you max 100 shareholders, so you don't have max control, and you're not allowed to actually go on this stock exchange and become a public company because first, this limits you to only 100. It's very little if you're trying to become a big time company like Tesla or McDonald's, etc. But again, I'm not your attorney. The rules might change, and always do your own due diligence. So that's typically what that is. But for you, maybe you just start your business. Maybe you're a veteran. When you have an LLC, you essentially want to become to a point where you figure out the amount. We usually say 33,000 to 50,000 in net income. Some people say 70, some people say 50,000. Really depends on where you're living at, where your expenses are. You might be watching this in Canada, you might be watching this in Africa. That's a wonderful continent. You might be watching this in Europe and Asia. There's so many different countries and continents and different rules and stipulations and articulations that you want to make sure to check with your local person. I'm just sharing an ideology and a perspective, but again, don't sue or litigate me, just sharing. But beyond that, that's what those are essentially. And so if you want to decide, you need to figure out, are you on more of the side where you want your income to be passive? Like, for example, say you buy a piece of property and someone's renting it, or you buy a fleet of cars and someone's renting them from you and it's kind of just generating itself. That might be something more for an LLC. Maybe, maybe not. It really depends on your taxes. Maybe you're someone who is an active physician and you have an active practice, or you're a doctor of some sort. Maybe you carry a JD degree, a Juris Doctor, and you're a lawyer, attorney, you're Esquire, and you have a firm. And maybe you're a single attorney, you just got out of law school and you're like opening your first firm, or maybe you're practicing with a partner. You might want to look into that, and that might need maybe a corporation, or you might need to elect to become an S Corp. Really depends on the tax implications. This isn't a tax video. I'm just sharing what's different. And at the end of the day, by the end of this video, you'll figure out that there's no real one size fits all. It really comes down to what you want. Again, if you're someone who's maybe a rental investor, you might want to go towards LLC because you want this, your income's flowing in such a way where you speak to your CPA or tax person where they're able to offset or give you tax deductions because you're not being paid. Because when you become an S Corp, you have to actually set up a payroll company and pay yourself. And the cool thing about this, though, you're able to get rid of self-employment tax when you become an S Corp, because essentially what's going on is you're able to pay yourself. You could pay it once per year, once every month, every few weeks, but essentially you're being paid as the employee. So you're the employee now. But when you're an LLC, you're not paying employee. So when you're running a rental passive business, it might benefit you to have a rental company that's ran by LLC because there's no employee, so this kind of flows through. But if you're actually actively working in your business, you might need an S Corp. Anyways, like, subscribe, share, follow more videos. Welcome to Pearson Bryson.